You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi everyone, it's Jake here. Welcome to The Voluntary Life. This week's episode is about entrepreneurship and specifically about venture capital and the role of venture capital in entrepreneurship. Should you try and go for VC funding for your venture if you're an entrepreneur? And what will happen if you do? Well, to help me address these questions, I'm interviewing Warren Hogarth. Warren is the co-founder and CEO of Empower, an app that helps entrepreneurs and side hustlers stay on top of their finances. And prior to launching Empower in 2016, Warren spent 8 years as a partner in the number one venture capital firm in the world, Sequoia Capital. During his time at Sequoia, they invested in companies like Square, Uber, WhatsApp, Stripe, and Airbnb. So Warren has been on both sides of the table when it comes to entrepreneurship and venture capital, and he has a lot of interesting expertise to share for entrepreneurs. Before we get to the interview, though, I just want to remind you that you can get bonus episodes and many other rewards by becoming a patron of The Voluntary Life on Patreon. And if you're interested in doing that, you can check out the link that I'll put in the show notes, which you can access directly on your podcast player, or by going to my website, thevoluntarylife.com, or directly to my Patreon page, which is at patreon.com/thevoluntarylife. So without further delay, here's my interview with Warren Hogarth. Okay, Warren Hogarth, welcome to The Voluntary Life. It's great to have you on the show.
Jake, it's a real pleasure.
I'm really interested to talk to you because I think you have a lot of expertise that is very relevant for my audience. My audiences have a lot of entrepreneurs and people interested in financial independence. And so your story is, I think, very interesting for both those aspects, and in particular for the entrepreneurial side. And you've got an interesting background, which I think it would be good to start with to tell my listeners a little bit about your own journey. So can you tell me how you got into venture capital and ended up at Sequoia Capital?
Certainly. It's one of those sort of serendipitous journeys. I'm an Aussie, as we were chatting before. I grew up in Brisbane, Australia, and spent a lot of time in the outback on my grandparents' cattle property, or ranch as they'd say in the US. And I was going down the path of chemical engineering. My dad was a chemical engineer, and I really enjoyed problem solving, and it seemed like a good fit. And I was actually going to go design oil refineries around the world. The first one I was supposed to work on post-college was actually not far away from where you are now. It was in Scotland. It had blown up a part of the refinery, and they needed to rebuild it.
All right.
So it sounded like a fun thing to do as a kid graduating college. But I went to this lecture from a professor talking about, at the time, the future of materials and the future of biology. And I'd had this summer experience, and I was like, and I had like a little lawn mowing business and tutoring businesses and whatnot on the side, and through college and through high school. And I just didn't want to work for a big company, I realized, and I didn't want to work in an industry that was going to be the same for the next 40 years. And sort of it kind of had reached its peak. I wanted to be part of something new. I wanted to be sort of that feeling of being in control and that exhilaration and sort of adrenaline rush you get from like the highs and the lows of being your own boss and starting things that are new. And so I actually went down the path of doing a PhD, which was my way to do research, to try and develop technology, to start a company, and also for me a way to try and spend some time overseas and experience new countries and new environments for building companies. And so that took me to the US. It took me actually to Germany for a while. While I was in the US, I had sort of fallen in love with the entrepreneurship and sort of the fact that someone who's 23, 24 years out of college could go and raise a few $1 million to start a wacky idea that might have no revenue for 2 or 3 years. I mean, back at home, and things have changed in Australia now as well, but back at home at the time, the sort of career tracks was the traditional way things went. And even if you were sort of, whether you want to call it crazy, talented or whatnot, you sort of had to sort of go down this very specific path. And I was attracted to that. I came back to the US and did did an MBA at Harvard Business School, and then again through a really a range of serendipitous events where I was just doing whatever I could to use the time while at school to go and meet interesting people, because when you send someone a blind email and you say, hey, I'm a student, would love to just take half an hour of your time to learn about your career, or I'm really interested in what you're doing, I've been studying this stuff, I had a few questions for you. A lot of people will say yes. And so I was flying myself out to Silicon Valley, crashing on a friend's couch. He was very kind, and just doing whatever I could to meet interesting people. And literally through that serendipitous that sort of getting out there and meeting people, I had sent actually a friend had said, hey, I hear these guys at Sequoia, who I didn't really know anything about at the time, are interested in meeting people with like PhDs and energy backgrounds. And I literally sent a blind email to an email address, like 3 or 4 lines with sort of a pitch on, hey, I'd love to connect. And a few weeks later, they said, do you want to do a phone call? I said, no, I'll actually be flying myself out there soon. How about a coffee? And a few more weeks passed, and they responded, and I met a few people, and the rest is history. We sort of hit it off. And so it's about just putting yourself out there and hustling and doing what you can.
That's awesome. Yeah, that's a great example of how you can actually create opportunities in that way. And how long did you stay at Sequoia?
So I was there just shy of 8 years. Right.
And during your time, I understand that you were involved in a lot of deals that people will probably have heard of as well.
Yeah, so Sequoia Capital is a very well-known venture capital firm in the U.S. where I was focused. There were 8 of us doing investing, and I was sitting around the table when the founders of Airbnb came in to raise their first $600K. It was 3 of them. This was in, I think, the beginning of 2009. Another company called House, another company called Stripe, if you're in the sort of developer payments ecosystem. I was in the room when we thought about the Series A investment of Uber, but we decided not to do it, which was a giant mistake. And so later on as a firm, we invested, but it's, and then personally, I was on the board of about half a dozen companies by the time I left. One now is public, a few others are sort of unicorns. So it was a pretty amazing experience.
That's great. And I think this is where your view from having been on both sides of the table, because we're going to talk about what you're doing now in a bit too, but your view from having experienced both sides of the table in venture capital is very helpful. And so I'd like to do a thought experiment with you. If you had a friend who came to you and said, Warren, I've got this business, I need financing, I'm thinking about trying to pitch to get venture capital. If you had a conversation and thought that this friend was perfectly placed to really make the most and get the most out of venture capital, what kind of qualities would that entrepreneur and that business need in order for that to be the right route for them to consider?
Well, it's a great question. The fortunate thing is it doesn't have to be too hypothetical. This happens to me about once a week, including yesterday morning with one of my friends who had reached out and, is sick of his job and has an idea. The first thing I think you sort of hinted at it there, but just taking a step back, the first thing is, what is, I always try and help people think through, like, what is the quality and what kind of business are you trying to do? Is this like, what's more precious than money is your time. And so, like, is this a worthwhile endeavor? And then the second thing is, what is the right way to effectively capitalize the business, of which venture capital is one of the ways. But if you take venture capital specifically, the way it typically works is, you might be doing an early round, which might be called a friends and family or a seed round. And then, they have this concept of where that often is, a few $100,000 to maybe $1 or $2 million. And then, the stakes go up from there. The next round, you might raise a few $1 million to $10 million. And, many of these companies end up raising $50 or $100 million plus over their life before they're profitable. And, so if you want to go down that path of venture capital, it's sort of a very high risk, high return path, because, once you take that, the person who's investing in that first round, they're probably, going to write off, let's say 70 or 80% of their investments. And so the ones that make it, they're hoping for like 20x return.
Right.
And, when it gets to the Series A, they're probably writing off a third to 50%. So the ones that win, they need to make 10x return. And so this has to be the kind of business where, if you're going to raise this money, you can, over time, grow to tens of millions on the low end, and in most cases, hundreds of millions of market cap over time, which is possible. But it's not the only way of doing things. So first thing is like, what is the size of the opportunity of the business? What do you want to do? How much risk do you want to take? If you think you can grow a business that's, hundreds of millions of dollars in market cap, which generally means you can get to, 50 to 100 million plus of revenue over, 5, 6, 7 year period or timeline, then, venture capital is a great path for you. But there's plenty of people that have grown amazing businesses where they, bootstrap it by, simply funding it out of like sweat equity, where you're not taking a salary for a period of time, or a very reduced salary, or you're using credit card debt, or maybe, you raise a small amount of capital from friends and family, and maybe you grow a business that's, a couple of million to 5 or 10 million in revenue over time, but you're in control basically the whole way through, and you have a lot fewer pressures. And by, it's much better to own 50 to 100% of a business that's generating 5 million revenue than owning 5 or 10% of a business that, is generating perhaps 10 or 15 million in revenue, but doesn't make it out the other side and has raised a whole bunch of venture capital. So there's a long-winded answer, but it's a very nuanced set of paths. So I always sort of start with, hey, what do you want to do? How big could this business be? And what's the quality? And then, hey, what's the best way to capitalize it over time?
Yeah, absolutely. And I can see, clearly the scale of your financing needs and the scale of the opportunity that you think you have is really key. Putting the question a slightly different way, would there be, can you imagine cases where you would say to friends, look, forget about venture capital because that's just not right for you? And what are the kinds of things, you mentioned the scaling, but are there other things that you think would be important to think about as being really signs that you should not be considering venture capital, that you should be looking to bootstrap or revenue finance, or maybe go for, friends and family, and if it's a smaller thing? What kind of things would you point out to that friend if it was not the right route for them?
Yeah. So I think, again, a few things. When you raise venture capital, not only are you getting diluted by the equity, you're sort of the pressure to perform very, very quickly, because you now have other people on your board, and the fact that now that you've raised this money, that like creates a minimum sort of exit and threshold that you have to get to be successful, and generally to raise the next round of capital. It's almost never one round and you're done. And so again, just thinking through, also from a personal profile and point of view, you are in more control if you don't have to raise money. It's always better to have to raise less or no money at all. So if you can sort of revenue finance something, or put some sweat equity in and generate revenue and use that to bankroll a business, it puts you in 100% control of the business, but it also gives you a lot more flexibility and decision making down the road. You trade off against that. It's not just investment that you're getting from a venture capitalist. You're getting effectively a coach and company builder to help you build the business and think about building the business and recruiting other great talent, et cetera. But, for example, a lot of people, if the idea isn't fully formed or you need to do more testing, that's another way to think about it. And this is some of the feedback I had to my friend who's still in his other job. The way he's thinking about doing this is stepping back from his other job, where he's actually been on the side collaborating with someone, and they've already got they've developed an idea and they've got 2 potential early customers for it. And so he would step back now so that, he doesn't get IP tangled up and what have you. He's thinking of doing this in a way where he might do some consulting on the side he's also thinking of downsizing his house and doing a bunch of other things to reduce his personal burn rate and needs. Doing a little bit of consulting on the side, but for the first year or so, closing those first few customers and continuing to prove things out before going and raising a round of money. And that, it increases your valuation and your leverage when you go to raise money, but it also puts you in more control, because let's say they get this into a nice place in a year from now, but it's not something that might be a $100 million outcome, but maybe they've created something that's $1 million or $2 or $3 million value that they might be able to sell. And if they haven't raised any money, they haven't taken on other employees, they've got a lot more flexibility to do that. So there's a timing element to it that's important too.
Right. And when someone does, if an entrepreneur is thinking of going for venture capital, I'm guessing that you've obviously seen, examples where things have worked out really well for them and examples where it hasn't worked out well. What kind of things do you see typically are the things that you need to watch out for in terms of pitfalls as an entrepreneur if you're going to take on VC funding, and how would you avoid those pitfalls?
Yeah, so one thing to think very carefully about is you kind of have, with the highest quality investors, you kind of have generally one main bite at the apple in terms of like pitching them. And so the first thing I'd say is just make sure you are very, very prepared before you sort of reach out and sort of take a crack at it. And a great thing to do is, pitch to, if you have any other friends or whatnot that are have pitched before, you could do dry runs with them. If you've around any accelerators or incubators or business plan competitions, those are great sort of training grounds. When it comes to taking capital from anybody, whether it be a venture capitalist or a seed investor or what have you, there's a few important things to look for. One is, what is their experience and sort of past behavior? Because once you take money from somebody, you are stuck with them, whether you like it or not, until basically the end of this business, some kind of exit event, which, can be 6, 7, 10 years down the road. And, part of an investment, especially a venture capital or a seed kind of investment, there are certain preferred terms that come with the stock and with voting rights and blocking rights and various things. And so, you want to be very thoughtful about who you're taking money from, certainly make sure you're referencing those people. And ideally, you're bringing them in because it's not just money. One of the biggest impact that investors can have on an early stage business is helping you get customers, helping you recruit employees, or helping you navigate something unique to the industry that you're in. And so I would really advise that you look for those kinds of people. And then the terms of which they lay out at the end of the day, where the rubber meets the road, that's also a very strong signaling factor. In a very mature market like the US, the typical seed terms these days are considered quite founder friendly. If I go back to Australia right now, and sometimes if people are a bit naive from the entrepreneur side of things, and there's some, let's say, opportunistic, early investors, they put all kinds of nasty terms in the term sheet that says, it's not just that it's a preferred security, it's like participating preferred, or it's got ratchets or crazy voting rights. And these things might not mean anything to someone now, but you want to make sure you're very, very, you really understand the terms that someone is putting in front of you when it comes to raising money. Because that stuff, if someone's being opportunistic now, they're going to be opportunistic with you throughout your whole relationship.
Right. I think that sounds like incredibly good advice. When I went to, I never took venture capital for my business, but I did sell my business, and the terms of that sale were also quite complex. And I actually was very fortunate to find a very good advisor to advise me on those terms. And there was a lot in that I wouldn't have known would have been important if I didn't have that kind of advice. So I can very much imagine how it would work in a venture capital situation too.
There are actually some, if people Google, I think Y Combinator has published some standard kind of seed docs, and there's 1-2 other places on the web where you can sort of, if you are thinking of taking money, and let's say you can't afford a lawyer, like a high quality lawyer, and you want to do a little bit of legwork yourself, you absolutely should have a lawyer, by the way, when it gets to that level, just to look over these things. But there's a couple of good references on the internet of like sort of standard terms and what have you.
Right.
That I would certainly encourage anyone at that point to look out to. But again, it's not just that. It's like, what are you going to get from this investor? And, what doors are they going to open for you? And what have they done for past companies? How have they behaved with past companies in good times and in bad times?
Right, absolutely. I'd like to ask you about the journey of an entrepreneur in scaling a business of the kind of scaling that we're talking about if you're thinking about venture capital, because there's a kind of quite a well-known difference between maybe the mindset and the characteristics that you need to be a startup entrepreneur, to come up with something creative and new and different, see a really interesting opportunity, and the kind of skill set that you need to really scale a business. And in particular, as you mentioned before, Warren, if you're working with VCs, then you're going to have a lot of targets that you need to reach, and you're going to need to proceduralize everything and really change the nature of the business in terms of scaling. What do you see as the personal challenge for an entrepreneur to go through that transition? And I mean, I should imagine that a lot of them don't really make it, in the sense that it's not the same people running the business once it gets significantly scaled. So how, as an entrepreneur, should you think about that challenge?
Yeah, it's if you break it up into a few phases, there are certainly these sort of very important transformations that a leader of a business will go through. If you sort of think of the 0 to 1 being, an idea that for a product, or you've sort of started to prototype a product, to what a lot of people call proving sort of product market fit, where customers are actually buying or adopting your product as you would hope. A lot of that is very focused on a very product-centric mindset. A lot of the team is, heavy on the developer side of things and the builder side of things, not particularly a lot of sales and marketing. That's sort of, and often the teams are sort of small. It's sort of, a few people to maybe 10 people at that point. That's sort of one phase of a company, and that's often the most comfortable phase, because it's, someone's come up with the idea and it's compelling enough to raise money and what have you, and execute on. That's sort of generally what most people are familiar with who are starting a company and sort of risk takers. The next step is, okay, let's say you're at 10 people are buying this stuff. Okay, now I've got to scale it. I've got to build out marketing. I've got to maybe have to build out sales. I'm going to have to scale the development team. You've got to think about bringing in engineering managers or product managers, early sales leader, which might not be your sales leader later on. Similar on the marketing side of things. Are you going to build out, if you're doing a heavy sales business? Are there inside sales versus outside sales? What's a sales development rep? What are the various models for doing this? This is obviously where having board members or advisors to the business that have built and scaled businesses in the past becomes very helpful, because many of the entrepreneurs we back, I used to back, and personally still do some seed investing, it's their first time. So that first phase, they're generally pretty comfortable with. They know a few people to hire and can build a sort of a rock star team. Then it's about, how do I get leverage and scale? And I can't manage everyone directly in the company. And that's where, having some advisors that can help you understand what the right sort of models and metrics are and who the right people to hire are. And then it's about, bringing in leaders for each of those functions, perhaps, whether it be, as I said, engineering, product, marketing, sales, customer success, that have the experience to both, be the one-person shop, the first person that, just does customer success, because you don't need 5 people out the gate or sales, but then can, hire other sales execs, build out teams, scale teams. It evolves from, 1 to 10 people. So then you start bringing in some of these people and maybe go from 10 to 40 or 50. And then if you're going to, go from 50 to 250, there are these sort of very large transformations from everyone in the company. And, the fun part is it's an exhilarating and phenomenal time. It really tests you as an individual. It attests your ability to, relinquish control over a whole bunch of pieces and trust people. And some people can and want to go all the way through it. Some people get to a point where they say, hey, I loved being focused on product, or I loved interfacing with customers, and I don't want to be, spending 60% of my time interviewing and managing and raising capital. And so I want to, find a partner to come in and do those things so I can focus on what I either enjoy or where I'm most strategic. And other people say, hey, I want to continue to grow and go as far as I possibly can with this. And, it really is one of those things where you have to see how it goes over time.
Yeah, absolutely. Is it, in your experience, what would you say is the proportion of entrepreneurs who take venture capital, who do make that transition through, versus the ones who at some stage either say, okay, look, I'm not interested, I want out at this stage, or, and unfortunately get pushed out because they're not handling it at a different stage. So what percentage would you say of founders make it through that transition process?
Yeah, I'm just trying to think with the companies I was involved with. We had the ones that I was directly involved with. I think 2 of the 7, about that. So about 2/3 the founders scaled.
Yes.
Continued to sort of scale the company, and about 1/3 by their choice. It got too complex. They're still involved with the company, but they elected not too complex, but it was just
it's not what they wanted to do
over their head.
Right.
They generally see, you've got 50 or 100 or 200 people that you're responsible for, and if you think someone else can be doing some of these things better, they elect to focus on, again, a more narrow piece and have someone else who's operated a team of 200 or 300 people come in and be a partner.
Right. Very, very interesting. And so I wanted to ask you about your change now, because you're now running your own business. So can you tell us a little bit about leaving venture capital and starting Empower?
Certainly. So I had this wonderful period where I'd seen some amazing companies be built and helped build a number of, as I said, I think 3 of my companies now that I invested in at the very early stages have grown into unicorns and are hundreds to thousands of employees. And when I was early and involved, it was 3 or 4 employees, and so it was amazing to see that. And for me, it was an experience I wanted to live as the person in charge rather than the coach or advisor. In my prior role as investor and a board member, and I saw this amazing opportunity in the U.S. where consumer finance. So I started this company called Empower. It's about bringing the best financial advice and automation to anyone who has a bank account for free. It's sort of the advice that the 0.1% of people get on how to optimize their finances. You can do all of that in algorithms, and you can distribute it as an app so that, I don't know if you've had a friend or a family member say, hey, what should I do in situation X, Y, or Z? But, that can all be productized, and it can actually be flipped on its head and be proactive in the sense that, we're constantly, the Empower algorithms are constantly looking over your finances, and there's a way to optimize, to save money, or something that you could do to improve your situation. You get a push notification, and then in most cases, in a few taps, you can take action on it. You can, refinance a loan, or open a new bank account, or move money to a high interest savings account, pay down debt. There are all of these things that, we thought we could, make freely available to anyone so that people can truly sort of get themselves into a better financial situation. And it was just really brought about by a few things. One, my own personal experiences with the financial system here in the US where, my credit score is still impacted today by the fact that when I first arrived in the US, I decided not to get credit because I didn't need it, to the fact that, when I left venture capital, like I was penalized because I didn't have W-2 income or salaried income. I became a contractor, and, you got all these ridiculous, the banks just don't want to underwrite you over here, to the fact that most of them are trying to keep you in their walled gardens and give you shitty interest rates or shitty loans. They don't realize, or most people don't realize, that if your credit score improves or your financial situation improves or your job improves, you can often go and refinance your loan and save, tens to hundreds of dollars per month, for example. And so we thought we'd just give that away for free and really help people get ahead. And, then over time, where we make money is where we're also focused on building new financial products for people. So especially for people that have contract income or haven't had credit in the past but are responsible people, we think there's huge opportunities to build new financial products for them. And so that's what Empower is about. That's what my journey's about. And so far, it's been a lot of fun.
That's great. I'm curious to hear, what did you do when it came to financing your business?
So, we bootstrapped for a while, and that was because we wanted to, as I said, we had a really strong idea, so myself and my co-founder, and so it was basically bootstrap. We took no salary for a while, and invested some of our own money in the business early on, just to where we needed to with some help for some contractors and some software infrastructure and tools to build out an early prototype of the business. So we did that for about 4 or 5 months, until we felt that we had something really compelling, and then we had validated that there was a lot of customer demand for what we wanted. And then at that point, we went and raised some seed capital, in this case from Sequoia Capital, as well as a handful of angels or friends and family that we thought could be really valuable to the business and help advise, or had wonderful connections. And so we raised a seed round from them, and then we launched the product, and then we subsequently raised an additional round of capital from some other great investors. And so we staged it, but we started that sweat equity bootstrap, prove that we can build a compelling product, and there's people who are going to use it. And that, again, it helped us, increase the valuation of which we would have been able to raise money at, and put us in more control of our business.
Great. Well, it's really interesting to hear about both your experience in VC and also about what you're doing now. For people who want to find out more about you, where's the best place to go online?
Yeah, so Empower is available in the Apple App Store and in Google Play Store, or if you go to empower.me on the web, we've a few 100,000 users now. We were one of Time's best new apps for 2017. Product Hunt, we were the only finance app nominated for App of the Year in 2017. And so there's a fair bit out there now. Hopefully you may even have some friends that have used the product. If it's a US-focused product for now, we will be expanding internationally later on, but it's a US audience, US banks. And if you want to get in touch with me, I'm on Twitter @WarrenHogarth.
Brilliant. Warren, thanks so much for coming on the show.
It was a real pleasure, Jake.
Thank you for listening to The Voluntary Life. If you like this podcast, please show your support by becoming a patron of The Voluntary Life on Patreon. Your support will help to grow and improve the show, and you'll get access to a treasure trove of rewards, including bonus episodes. Visit thevoluntarylife.com to learn more.